Hey everybody, Jason Sherman here. I speak to SME funding champion Ciaran Burke. Welcome to the show.
Thanks so much, Jason. Delighted to be on.
Awesome. And today we're going to talk about $2 billion in SME funding secrets every business owner should know. So everyone who knows me knows that I'm in the middle of raising money for my startup. We have an AI business just like everybody else, right? And we're doing the VC route. It's difficult, right? It used to be different. I want to say maybe 5-10 years ago, maybe even longer than that. But in the 5-10 year range, you were still able to raise money with traction, revenue, a good platform, and a good team. These days, not so much. And I'm confused mainly because I've written a book about it. I've taught a course about it. I tell people, get traction, revenue, a good team, and a good platform, and you'll raise money. But these days, investors are not doing that. Do you know what the situation is?
Yeah, I mean, wow, what a killer question to open with. Absolutely, I think your testament is true. It is so much harder to get equity-based funding these days comparatively through. And I think one way to think about it is actually from the top, so the top of the food chain. Where's that money circulating? And I think if you looked at maybe 10 or even 5 years ago, you would have seen a lot more IPOs, a lot of people going to the public markets a lot earlier. But what's happening now is they're staying much longer in the private markets, and a lot of these VCs that are gobbling up and expunging, or private equity money is spending a lot more in that private market. So therefore, a lot of that capital is potentially being tied up in those bigger tickets as they go through those private funding rounds. And the knock-on effect to that is there as much appetite to try and be a bit more courageous, a bit more contrarian, and go in at that earlier stages. So, like you say, Jason, you may have all the proof points in there, but if you can't find that source of capital at that right time, it can not necessarily be down to your business, but just a sign of the market.
Yeah, and I've been in a couple of roundtables with other peers or CEOs and the industries around me in my city, and the word that's been popping around is seed strapping, where instead of bootstrapping, where you're scrappy, you actually do have some money, whether it's operational funding and or your own money and or a seed round from friends and family or an angel. And they're now saying, well, we don't want to raise VC money. It's already kind of difficult, as you just mentioned, but if we're able to scale with just a seed round or revenue, then that's the way we want to go, because then we retain equity and we can grow with revenue. So what are your thoughts on that? And is that, I mean, obviously it's difficult, but what are your thoughts on the difficulty level of that?
Yeah, so I think there's a lot of kind of pluses, I think, to that methodology, because sometimes, particularly for first-time founders, there's a huge attraction to raising VC, and it's so glamorous. Whereas, like you and I probably both know, it's hell on earth. It's absolutely
Yeah.
excruciating. You have to kiss so many frogs. The deal cycle takes
Ribbit.
absolutely ages. You think you're there, but it's this never-ending finishing line, and it's so taking you away from your business and taking your mind to somewhere else where you should
And
be.
now you have these people breathing down your neck every day too, right?
Yeah,
Expecting results.
exactly. So actually taking a step back and thinking about, like, do I really want this, or are there alternative pathways that allow me to have much more of a lion's share of my business, allow me to incrementally grow the business, not at, say, maybe the velocity of a VC initially, but allows me to grow, build sustainability in it, and in turn change the valuation dynamic completely as to when you may
Yeah.
want to talk to the VC. And I think absolutely thinking about it from a bootstrapping or seed strapping, as you say, way of doing it is really interesting. There's the friends and family market. In the UK where I'm based, there is some pretty good governmental schemes from a tax perspective that allow for a lot of private investment that isn't quite VC money, but it allows for a lot of friend and family participation. So there's one for business.
Does that also include angels as well, or is that
Exactly
something?
that. So say even like our own business, within your first year, 3 years, you can use this thing called SEIS. But what it means is, if I gave you $10,000, I can get $5,000 back from the government straight away. by giving
Interesting.
money that. And say for whatever reason, I'm sure it would never happen, but if your business was to fail, I would get a further 25% back from the government. So I'm effectively
Wow.
risking 25% of my money, which is incredible.
We
So
need
that
one of those plans in
yeah,
America.
so it's really really good. Like it's really awesome, and
If we had that kind of program here in America, I think more people will be investing in companies for sure.
absolutely, it's a great one, and it's got a big brother program. It's called EIS. Instead of the 50% back, I get 30% back, but I get a further 25% if it was to go there. So again, I'm risking 35% of my capital, but I'm getting in super early at a business. So it's a great way to get in friends
You
and
know,
family.
if you guys had better weather over there, I would think about moving over there.
But at the same time, you guys have some great schemes as well. So I think like the SBA, the Small Business Administration Program, is a really interesting one. Uh,
Okay.
Particularly in businesses that are kind of stepping into the franchise world.
Right.
So you can see things like that are flying, like
So
Chick-fil-A.
let's talk about that for a second. Like what you mentioned, alternative funding. So like, in a startup, our first thought is angels, VCs, because we want to scale quickly and we don't want debt, right? We just
Yeah,
want equity-based funding so we can move quickly. I
yeah.
understand you're laughing because it is debt, but at the same time, it's not, you don't have to pay it back until you are
No,
successful,
of
right?
course. Yeah.
So let's talk about the alternative funding options that people maybe don't know about.
Yeah, so I think that people do need to sometimes get comfortable with that, because as founders and entrepreneurs, you're doing it because you're passionate and you believe in it, but there is an element of putting some sort of skin in the game. And I think in all markets there are debt instruments that you can use, but also you should always be thinking about it in your numbers and affordability and cash flow. But absolutely, there are certain products that can be used to help you get from A to B. I mentioned the kind of SBA program, and that program can be pretty advantageous in terms of the size of capital you can get relative to the numbers you're doing at the time, as opposed to say going to a traditional bank, which would have evaluated based on your trading income, where you wouldn't be able to get that size of capital. But a lot of businesses are doing stuff in, say, the e-commerce space. So all of a sudden, the revenue that's coming through is coming through, say, their
Right.
Shopify
Yeah.
numbers or their Amazon numbers. There's
That's a numbers game right there.
yeah,
That's a very easy.
but plenty of the time, there's plenty of people that will look at those numbers and go, even after 3 months, once you get above $10,000 trading, they're willing to advance you capital that you can
Well,
use
yeah, because they can do projections, right? You're earning this much month over month,
for
and
sure.
you're by the end of the year you'll have this much. But
Yeah,
let me ask you a question. This is something that people ask me all the time, and I want to ask you. You mentioned that people have to get comfortable with debt, right? They have to get comfortable with maybe taking out a loan for their business because they're passionate about it. But that passion, usually for a startup founder like myself and my team, we're all equity based, right? So we,
yeah,
we put in sweat equity, we put in time. And if we were putting that time into a Fortune 500 company, we would be getting paid, $150,000, $250,000 a year and making a ton of money working for this company, right? So we're not earning that money. We're basically earning $0. That is debt to us, right? We're
hmm
losing hundreds of thousands of dollars a year. So in our minds, we're thinking, well, we need to raise money so that we can continue scaling this and also get paid to do the job, right? Essentially. But now if we take on debt, let's say we raise $1 million from a bank or $500,000 from a bank, and then we have to pay them back. And it takes us a long time to earn that money back because, it takes time to earn money in a startup. Now we're not only not earning money for ourselves, but we're also having to pay them back. So it's kind of like a big situation. I'm curious your thoughts on that because that's what people ask me all the time.
yeah. Like, I mean, there's no gaining away. But if you take a loan, you need to pay that back. And there's just no getting away with that. There's no like
Okay.
abracadabra, wave a magic wand. Like, I'm not
I
promising
wish there
anything there.
was, man. I wish you were going to tell me some
But
secret.
I do think you also need to bring it back to the business fundamentals. You're investing that time and energy to create something, to make something happen. So it should
Yes.
always be steeped in a forecast model with permutations and levers that you believe to be true. And so I'm not saying everyone should go out and take a loan, but absolutely you should look at a loan within your model and you go and say, taking your example, if I did take $500,000 and I got that into the business now, what would that do to me? And I may be able to structure the loan so I have a bullet payment that pays at the end. So I'm doing it in an interest-free period. So I know from a cash flow perspective, maybe over the first 2 years, it's going to be a minimum cash flow to what's going out. what
Got
can
it.
me and my team do in that 24 months? In the
Yeah.
same way that you would have to do that for an equity person that say, I'm giving you this check to go and do that. And
Right.
if you can go through that exercise and believe it to be true, then you know you can create sufficient upside on the revenue to be able to afford that in the future, or pay it down, or refinance it, whatever it might be. But there are other elements as well. There are grants. There's also the R&D tax systems, or sorry, research and development for those not familiar, or SHRED. And so for those businesses that are investing in deep tech, or AI, or any form of technology, or process change, or science, all of that effort and time can be put back through from R&D tax credits.
We,
So
we do have to, we do have to mention something about that though, because we've tried doing those for many years. The R&D
yes,
tax credits. We should probably mention to everyone that in order to get them, at least here in this city, your employees have to be in this city. If they're outside the city, you can't. And most of the people that we have, we're working remotely, right? So when we do say we spend $250,000 in a year, and only 25,000 was spent in the city, 225,000 can't be written. And it's like, are you kidding me? Like, we could have gotten so much money back. And like,
yes,
why they do that, I'll never understand that. But it
yeah,
kind of defeats the purpose in an online world, you know?
yes. But again, where you're trying to find an edge or a hack to get up and running, do you feel like there may be another city or another country where those rules aren't at play? We see
Yeah.
like
Yeah.
states, or not quasi states, like Puerto Rico, having very
Oh, right.
advantageous
Very
R&D
lenient
tax
for
schemes
entrepreneurs.
for entrepreneurs and things like that. So maybe you might need to think laterally, or if you think going north of the border. Certainly, Ontario within Canada offers very attractive R&D credits,
Canada's
particularly
definitely good.
on the entrepreneur side. So I
You
completely
have to
agree.
be willing to move somewhere else,
For sure.
basically. And
Like,
a lot of entrepreneurs are kind of set with their families, their infrastructure. You know, everything is kind of set in stone. They have houses, and it's kind of hard to pick up and go. So let me ask you this question before we start to wrap up. How would you help someone decide if they should either raise money, get a loan, or bootstrap? Like, what? Give me examples, like, so people can understand that.
So I think it's first and foremost understand kind of where they're at a revenue generating side of thing, because if you're in a pre revenue side of things, something like debt is quite hard to do unless you're looking at a kind of a franchise SBA model. So the first thing I'd be analyzing is like, how close are you to being a trading entity? The other side of it as well is on the equity VC play. I'm thinking about it from the market sizing point of view, because outside of friends and family, if you're looking at an independent investor, they're not going to really look at you outside of pure cold blood at the very beginning. It's like,
Right.
can this person realize a gigantic market?
Yeah.
Segment one. Segment two, do they have an edge outside of what this proposition is saying to me is, and do they have an unfair advantage in a way? And so, like, if those can be answered yes and yes, then absolutely, then there's an optionality to look at that equity play. But if they're not there, then I am looking and moving and the kind of the debt and the grants landscape, or the private friends and family aspect, to get into a stage where we feel revenue needs to get to. But I think for me, fundamentally, it's starting with that kind of forecast or financial model, and what those key drivers are for the business.
Got it. And what you're offering today is Swoop Funding, swoopfunding.com. How is it different than traditional lenders or VCs?
Yeah, so like like what we've been talking about, Jason, we fundamentally don't believe in one product. Like, whether you're
Okay.
a brand new startup, a second time founder, or a general, just a small business owner, you're not going to have one form of finance in your life. And that's what we fundamentally believe as a business, as a platform. So when you come on to Swoop, it's about kind of giving us your information, giving us your aspirations, so that you can see the whole market. So it's not just, here's one merchant cash advance. No,
Right.
let's look and see, is grants the option? Is equity the option? Or which lending option? So fundamentally, that's core to what we are. It's like, we want to stick with you as your up and down and roller coaster journey begins,
Right.
starts. And that's what we're about, having the option at the right time.
Nice. And where would they find more information besides the website? Is there any other places that you might want to lead people?
I think just straight to the website, swoopfunding.com, and you'll be able to kind of log in there. We're present in the US, Canada, Ireland,
Okay.
England, Australia, and South Africa.
Guys, check it out. If you're looking for funding, whether it's VC, private banks, bootstrapping, Ciaran's here to help. Swoopfunding.com. Check it out. Hope you guys enjoyed the episode, and we'll see you in the next one.